Hello, and thank you for joining us today for our webinar, 2024 Commercial Real Estate Insights for Region 3, that's Colorado, Wyoming, and Utah, with the National Association of Realtors Chief Economist Lawrence Yun. We'd like to take a moment to thank and recognize the sponsors of all of our chapters in these regions: Centennial Lending, Confluent Development, Colorado Real Estate Journal, Asset Preservation, Farha Roofing, Fidelity National Title, the University of Denver, the Daniels College of Business, and LBL. We truly appreciate their sponsorships. It's with their year-round support that we were able to bring you programming like this, as well as all of the other exceptional events you've come to rely on. We'll begin this session promptly at 2 p.m. We'd like to take this opportunity to thank all of our chapter sponsors again, and our webinar, the 2024 Commercial Real Estate Insights for Region 3 with the National Association of Realtors Chief Economist Lawrence Yun, is about to begin. Hello, I'm Dennis Baker with the Colorado Wyoming CCIM chapter. Welcome to today's webinar, the 2024 Commercial Real Estate Insights in Region 3. We're happy to share this webinar with everyone in the industry today. For members of the CCIM Institute, this is just one of the many member benefits that are designed to help you adapt and thrive in 2024 and beyond. Joining us today is the National Association of Realtors Chief Economist Lawrence Yun. He's going to arm you with the knowledge that will help you understand where the economy is and where commercial real estate markets may be headed in Region 3 in 2024. Please feel free to ask questions throughout using the Q&A tab. We'll be answering as many of them as we can at the end of the discussion. If you are experiencing any technical difficulties, please use the chat feature to ask for help with that. The recording and the accompanying presentation will be emailed to all registered attendees. Lawrence, welcome and thanks for joining us today. I'll turn the show over to you. Lawrence, you're muted.
Okay, I think that now it should be open. So thank you, Dennis, for inviting me to participate at this CCIM webinar. I have known Dennis, and he is doing fantastic work for CCIM on behalf as he works through the NAR. He is part of the NAR Strategic Planning Committee meeting, is a member of roughly 30, 40 people. Most are residential, but the fact that Dennis is there always asking questions related to commercial real estate, and also from the perspective of the Rocky Mountain states. So he brings a very unique perspective to NAR in some of those discussions. And of course, I also appreciate his invitation last year to come out to Denver to talk to people in person out for its Region 3 event. But thank you again for inviting me. Now, the real estate condition, commercial real estate, has been pretty rough lately. The commercial transaction volume, when I look at the statistics, it's been hard going because the rise in interest rate. Fast rising interest rate has really led to the difficulty in getting the financing. And also for commercial owners, the people who are owning properties, retail shops, office building, they have to refinance. It's not a 30-year fixed rate mortgage, as all of you know. It's a short term, 5 year, 7 year, that requires a rollover of those mortgages. So some mortgages that have been at very low interest rate from 2, 3 years ago, well, now requiring refinance at much higher rates, those are becoming more difficult. All this I can explain better with the PowerPoint slide. So let me put that onto the screen and then go from there. So hold 1 second as I do that. All right, so I have the PowerPoint up and put it in the slide mode. Okay, here we are. So first, the big driver of commercial real estate is coming from the Federal Reserve. So this is the key interest rate that impacts the commercial real estate market. The green line is the central bank Federal Reserve official policy. I am in Washington, D.C., so a few blocks from me would be the people who set the monetary policy. And one thing to note on this graph is, well, the overall interest rate environment at the beginning of the graph, which is 2019, pre-COVID. So to the extent that you view 2019 as being a normal condition, well, the interest rate today are much higher than normal. So just getting the interest rate back to normal would imply that commercial real estate can rebound, transaction, certainly the economic activity will be improved, which means leasing activity will come around. And furthermore, for the owners of commercial real estate, property values can recover with the fall in interest rate. So the graph shows 2019. In the middle is COVID stimulus. The green line essentially going to zero, bringing other interest rate down. The blue is the prime rate, the interest rate that the banks would offer to their most knowledgeable, frequent customers. And the red line is more long-term interest rate from the bond yields. So that's the 10-year treasury, and most commercial bank real estate loans, or say the CMBS market, would follow the red line along with some spread attached to that. So again, the key point here is in the middle was the stimulus. On the right side, interest rate environment is much higher than what it had been pre-COVID. If we were to just return back to pre-COVID interest rate environment, then it will greatly help commercial real estate. Now, one thing that I am monitoring, the key interest rate, the 10-year treasury yield, which is the benchmark of which most commercial real estate borrowing would be priced off. So this shows last year activity. So you see the 10-year treasury being essentially under 4% for most of last year, then steady climb. In fact, climbing up to 5%, which was a huge shocker for interest rate sensitive sector like commercial real estate. But since then, it has come down, but no longer. It stopped declining, and in fact, slight upward pivot that you see in the recent weeks. But I think we are past the peak. Well, I don't think we will return to the 5% treasury yield. But the question is whether it is going to begin to climb up slowly, stabilize, or can it return, go back down again? So the key benchmark interest rate that you see in front of you. Another interest rate that is being impacted is for consumers. Credit card interest rate, blue line, averaging 22% currently. The red line is personal loan. So maybe you have been very good, high credit score, been a good client. Every time you borrow, you repaid. But given the higher interest rate environment, you go to the bank, they will charge you a little more. The green line, automobile loan, even with the collateral on automobile, you see that interest rates are now approaching about 8%. So what this means is that related to potential consumer spending going forward, the higher borrowing costs could limit consumer spending in the upcoming quarters. So the economic activity, which may be fairly solid today, could weaken. Economic activity in terms of GDP, not commercial real estate. Commercial real estate is really hurting, but the GDP number looks respectable, but it could be limited once the consumer spending begins to calm down as reflected in this interest rate environment. But on the other side, here's the story on the other side. We have had record high stock market, except for today. Today is down. And home prices, on the residential home prices have been record high. So regarding consumers, we have American consumers who have record high wealth. So this may continue to provide support for consumer spending. The red line shows all the total liability. So it is much higher than the liability. So the gap between the blue and the red would represent the household wealth. So household wealth at a record high. The way I interpret the two graphs, this graph that says it will continue to support consumer spending, but this graph is saying it will limit consumer spending. The way I would combine the two graphs is that we have a segmented consumers. People who are owning property along with stock market are in a position to spend more. And that's our generally higher income category. But people who are on the more middle income, lower middle income, they are essentially stressed out. So we may not get robust spending growth. So if you are a retail shop and you are wondering, can I do more leasing activity on the retail side? Well, there could be some limitation on consumer spending, especially among the bottom half. Or the upper end, the consumer spending may continue to rise. Now, the Federal Reserve has indicated that it may cut interest rate 3 times this year, but they will not do so until consumer price inflation reaches 2%. Right now, consumer price inflation is 3.1%, or at least of January. Next week, I think the new CPI comes out. On this Friday, the job numbers comes out this Friday. But they want to see the number come down to 2%. You may say, what's the big deal between 2 and 3? Well, economic textbooks say 2 is much, much better than 3. So the Federal Reserve, with their hundreds of PhD economists working for the central bank, I'm sure was advising to say, wait until inflation is 2 before cutting. But I think there is a very good chance that inflation will go under 2% in the second half of the year, giving opportunity for the Federal Reserve to cut interest rate and thereby helping the commercial real estate sector. Now, one component of the consumer price inflation, because consumer price inflation includes everything: medical care service, college tuition, price of tomato. So it includes everything. One component that I am monitoring is rents. Now, commercial real estate practitioner naturally would be inclined to look at rents, especially this is an apartment rent, not office rent, not industrial rent, but on the apartment rent or the residential rent, the government is indicating that rents rose 6.1%. Well, I'm not sure if that's the case, but this is the official data. And the reason why I doubt this number is the following, and we communicate this message to the Federal Reserve. We communicate this message to the Bureau of Labor Statistics to say, please be mindful that apartment construction in the past 3 years has been at cyclical high. These 3 years would represent most apartment construction in 40 years. So you go to Salt Lake City and you see a construction crane and wondering what they are building, probably apartment. Same situation in Denver, Fort Collins, Colorado Springs. I am less familiar with Wyoming market because many small, more of a small sized town along with real community. But if there is a construction crane in Wyoming, again, most likely they are building apartments. So given that apartment construction is so high, one wonders, why is the rent still rising at 6.1%? And the answer is, well, the government is collecting the data, not quite sure exactly how they are collecting it, but when we look at the apartment vacancy rate, is rising. Higher apartment vacancy rate means one cannot extract continuously higher rent. The most interesting data point is this. Apartment rent growth, according to private sector data, not government data, is showing that rents are no longer rising. It rose strongly a couple of years ago. So if you are a property manager for apartment, you know that you were able to extract higher rent. Maybe this covered part of the fast rising the maintenance costs. Property insurance, I mean, those are rising super fast. So the rent growth has been solid a couple of years ago, but recently, because of oversupply or active apartment construction, vacancy rates on the apartment rising, rents are no longer rising according to private sector data. And let me combine the two together. So official government data, the blue line, I'm just replicating what I showed you earlier, along with the red line, the apartment sector data. So we have a divergence. So if the blue line was to eventually catch up with the red line, then we will actually have much lower overall inflation, giving chance for the Federal Reserve to cut interest rates. So again, we are sharing the data information with the Federal Reserve to say, look, you are following the blue line, but please be mindful. What we are hearing from the apartment sector is that inflation, the rent condition is much, much calmer because of active construction. The apartment, I think in Denver is already turning negative. I know that's the case in Dallas. It's the case in Charlotte, North Carolina, Austin, Texas. These are the market where there is strong job growth. So how is it possible that rent can fall in a fast job creating area? But the supply is outpacing the rental demand. So as long as supply is outpacing, one cannot extract higher rent. So little divergence in the figure, but I think the blue line will steadily catch up with the red line, which means that in the upcoming months, the rent number will be calmer, and that will make the overall consumer price inflation calmer, and therefore Federal Reserve to cut interest rate. Now, one stubbornly high consumer price inflation that refused to budge is on auto insurance. So this is an auto insurance. I think some of you who have to renew your auto vehicle insurance rate, you saw a little sticker shock, and it's happening. I mean, is that due to teenagers being more aggressive in their driving and getting into more auto accident? Or is it the case that people are texting more and therefore now there is also increased auto accident? But when you look at auto accident condition, it's not really that high compared to what the historical norm. So it must be something else. And I would say there's two probable reasons as to why this is rising. One is we are short on auto mechanics. So when there is an accident, well, given the shortage of auto mechanics, they can charge more. So this is implying that in America, maybe we need to start thinking about getting more people trained to become auto mechanics, construction workers, and other people who fix things, make things, repair things. Because I think we are sending way too many people to college just to read a book. And then therefore we have a shortage of auto mechanics. So maybe we need to begin to think about how to help trade schools, community colleges, rather than universities or condition. So maybe this will help contain the auto insurance. The other reason, and I hope it's not happening in the Region 3, in the Wyoming, Colorado, Utah, is that I'm in Washington, D.C. Every day we hear news. Teenagers smash cars. They're looking into the car to see if there are a couple of quarters, or they're just doing out of fun. They get arrested, say 2 teenagers, they get released. Next day, there's 4 teenagers. Well, they get arrested, they get released. The following day, there's 8 teenagers. So this is promoting misbehavior among teenagers and then more smashing of the car. So even though you may not be seeing the windows smash in your area, you are partly paying for it. We are all business people. We know that business people have to recover those costs. So right now, the crime rate is still has not peaked. I think it's still on the rise in the DC, San Francisco, other areas, and that may also be contributing to this higher insurance, which means that it's making the consumer price inflation a little higher. Therefore, interest rates are stubbornly higher for a little longer because we need that interest rate to be lower. But things like this is preventing it from declining in a more faster way. So to summarize this first part section, because I have other sections to go over quickly, just a quick review. Future rent growth should be calmer because active apartment construction. Future CPI, therefore, should be calmer, and the Federal Reserve can cut interest rate. It has indicated that it will do 3 rate cuts this year, but they said it's data dependent. They need to look at the data to see whether it's going to be 2, 3, or 4, or 5. But the trend line, I think, is definite that there will be interest rate cuts. Whatever they don't do this year, they will continue in the 2025. So it's over a 2-year time span, I think, where the total interest rate cut over 2 years could be 6 or 7 times. So we are looking at a slightly lower interest rate environment, but big red flag. Red flag is high budget deficit. If the government has to keep borrowing, that means there's less money available to lend for commercial real estate or any other private sector lending. So to the degree that government is constantly borrowing more and more, that may limit how far interest rates can decline. To illustrate this point, here is the government deficit. Blue bar shows total government spending, everything, national defense, Social Security, Section 8. One wonders, how much are we spending for illegal border crossing in the southern border as they're coming across? Are we providing little cash? Are we providing a plane ticket to go to other places? I'm sure it's adding to the number. Maybe it's not that significant in the overall, or maybe it is significant. But it's certainly part of that blue bar. The red line shows the tax revenue coming into Washington. So blue is government spending, red is tax revenue. If you look at the first half of the graph, it's almost the same, no big deal. But when you look at the second half of the graph, you see that blue line consistently outpace the red line. And then look at 2020. So focus year 2020, and it is a blowout spending. 2020, what happened? COVID arrived, that ugly virus arrived. And naturally, there was a stimulus, and you may say it's justified. We did not know what was going to happen, so that massive spending was justified. But we are now 4 years out from that COVID, and we are spending as if we are still in that COVID environment. Or let's say emergency spending. Maybe the type of spending is a little different. There's geopolitical matters that's happening around the world. And again, some of the illegal border crossings that's happening. So maybe it's different type of spending. But as you can see, deficit is huge. And if this deficit continues, it could crowd out money that is available for commercial real estate. So commercial real estate requires borrowing money, but if the government is borrowing all the private savings, then it would be less available for commercial real estate. Here's another illustration. The red line is national defense spending, salary for the soldiers, the tanks, the military aircraft. The blue bar shows the interest cost of the national debt. Given that national debt is high, interest rate higher, well, the cost to finance those interests will be rising. So in this year, it's projected that it will be interest payment will be exceeding the national defense. So one wonders, in the future years, if the blue bar continue to rise, this interest payment, some of which goes to Chinese government, because Chinese government also holds the US debt. If this blue bar continue to rise, one wonders, is it going to also crowd out national defense spending in the future? One really wonders, which is the reason that I will be listening carefully this Thursday night when President Biden addresses the country on his State of the Union. I'm sure he will say unemployment rate is low, inflation is coming down, but I want to see what he says about the national debt situation. And then there will be a Republican rebuttal, and let's see what they say about the national debt and how to address that, because it could crowd out commercial real estate borrowing and even potentially crowd out national defense spending. So interest rate environment today is higher. It will trend a little lower, not in a big way because the budget deficit, but it will trend a little lower later this year and as we go into 2025 because Federal Reserve will be cutting interest rate, much calmer CPI. So higher interest rate today, has that impacted commercial real estate? Well, it has cut commercial transaction volume by 60% in 2 years. 2021, well, you can say that was a little artificially high, low interest rate environment, but the activity is now below pre-COVID, vastly lower compared to that. Tough condition for people who are doing the investment transactions. Furthermore, because of higher interest rate, commercial property prices are coming down. So that red line is separation between COVID and post-COVID world. So commercial property prices in the aggregate is a little lower now compared to pre-COVID. So you look at some, I don't know, university endowment who have diversified their portfolio and investing in commercial real estate, well, the collateral value is a little lower. Now it is driven mostly by office property. Office properties are seeing the biggest decline. The industrial property, there is some price decline, but not as much as the office. So there is some variation, but someone who is owning a diversified commercial real estate property, where the prices today are lower compared to pre-COVID condition. And is it likely that there could be further price reduction? And answer is, well, let's compare the cap rates. So the red bar shows the latest average cap rates by property type. So apartment cap rate at about 6%, industrial 6.5%, office a little higher. And then I want to look at 10-year treasury, the benchmark 10-year treasury. Right now, today, it is at 4.1%. So it should be a little lower. So implied cap rate is that last bar, which is indicating that maybe office price adjustment, the downward adjustment is now sufficient. Maybe it doesn't have to fall further in the office. But on the other property sector, it's implying that there could be further price reduction. But this is not the full story because no one wants to buy office right now because the rent growth is difficult. While the rent growth in industrial is very strong, so even the cap rate is low, you say, well, the future, you can extract more rents in the future. So the industrial cap rate being a little lower is fine. We know that the apartment rents are not happening, but maybe in the future years, not this year or next year, but in the future years, rent growth in apartment could be very strong, which then would imply that this low cap rates could still be justified. And given the stability of rent collection in general in the apartment, may also justify a little lower cap rates. So let me overlay this graph with the rent growth. So the graph, red and the blue is exactly the same as in the prior chart, but I added the green bar to show what the rents are doing. So office rents, not even covering the maintenance costs. So office very difficult. Apartment is special, it's more cyclical. It's only temporary rent reduction. I don't think the rents will be very low, say 2 or 3 years from now, given the overall housing shortage. But this is the rent along with the other graph that I showed. Another thing that is impacting the commercial real estate is the following. This is showing large bank versus small size bank. So blue is top 25 large banks in the US and how much commercial real estate loan they have provided. It's been steady, no growth. But the growth in the commercial real estate loan has been done by thousands and thousands of small size banks. There are about 5,000 small size banks. So if the small size banks are in difficult situation, it means that commercial real estate loan would be more difficult. So there is, big banks right now are not more immune on commercial real estate difficulty compared to small size bank. March 2023, last year, 12 months ago, Silicon Valley Bank went under. Now, some of it is due to their bad business decisions, spending money on unnecessary things. So that was one. But the big portion was because they were holding on to asset that had low interest rate return. And then when Federal Reserve raised interest rate, they were completely flipped upside down. Many community banks were also in a similar situation as Silicon Valley Bank. But once Silicon Valley Bank went under, Federal Reserve did not want to see contagion, so they put a special credit line for the community bank to say, give me your bad asset and we will give you the full value temporarily. Well, this special credit line finishes this month. I'm not sure exactly which date, unless Federal Reserve decide to extend that credit line. So many community banks may still be facing some difficulties unless the credit line is extended. But one way to help community bank from the Federal Reserve perspective is to cut interest rate. If they were to cut interest rate, then the community bank would be much healthier because collateral values on commercial real estate returns, and also, the shocker, when there was a fast interest rate increase throughout the last couple of years, it hurt community bank, but not necessarily the large bank. It's not due to the management decision, it's just that the large bank were tipped off about the higher interest rate, while the community banks were taken by surprise. What do I mean by tipped off? It's just that large banks, JP Morgan, Wells Fargo, Bank of America, have regular meetings with Washington regulators, and they undergo something called stress tests. Stress test is where the regulator say, hypothetically, let me see your balance sheet if we were to raise interest rate by this amount. And if the balance sheet looks terrible, they tell Bank of America and JP Morgan to say, readjust your balance sheet so you can handle higher interest rate. So big banks were prepared for higher interest rate. The small size banks were not. And that's why when the small size banks are hurting, it's going to impact commercial real estate. And right now in the current environment, small size bank need that help. And only way to help is to cut interest rates. So I hope the Federal Reserve is very mindful, not only about consumer price inflation, but trying to minimize banking crisis by helping out community banks with the cut in interest rates. Let's look at some of the real estate fundamentals of Denver, Salt Lake City, two big markets in the region 3 of CCIM. I don't have Wyoming market, a more smaller community, but I think the trend line will be very representative. So sorry if I am not covering your very specific market like Pueblo, Colorado, or Provo, Utah. So let's look at office net leasing or net absorption. Office, there's job creation. Jobs are being added, but people are saying, I don't need offices anymore. So net leasing in Denver, negative with rising vacancy. Same situation in Salt Lake City. Salt Lake City, there are some quarters where office leasing is positive. So there are some companies, whether maybe new companies coming into Salt Lake City or if they want to expand. So it could be positive, going up, going down. So one may even say Salt Lake City is holding on better than Denver. Let me go back to Denver again. So this is Denver, mostly negative, while Salt Lake City is bouncing up and down. So this is the leasing condition. National office vacancy rate continued to increase. I think this year is going to surpass 20% vacancy rate. I know there is no standardized measurement on the commercial office vacancy rate. Each of the large brokerages has their own vacancy rate, but the trend line, essentially trend line is rising, rising, rising. And if we look at specifically in the Denver market, one can see that latest number, 16.4%. Pre-COVID, under 10%. So there is an empty spaces as one walks around the Denver area. I am in Washington. Many of the buildings here are fairly empty condition. So I think in any given day, the utilization of office may be 30% or even 40%, with other 60% vacant, even though it may not be officially vacant, it's not being utilized, which means that in future years, expect more vacancy condition. So office market, terrible condition, difficult condition. Uh, and like in Denver, where it could actually be somewhat risky to go to downtown. The drug abuse in downtown areas. Maybe people do not want to walk the downtown. Maybe this is also contributing to rise in office vacancy rate. This is Salt Lake City. Vacancy rates are much lower than Denver, only 10.7%, but it is above pre-COVID. Pre-COVID, it was only 6%. So if you're an office owner or trying to give advice to the office property owners, the rent increases will be very, very minimal. The maintenance cost is probably going to outpace any rent growth given the vacancy rate trends. Let's look at retail sector. Retail sector has been mostly positive, but lately either small positive or in some quarters a little negative. And this could be again downtown Denver. People do not want to go there, and it's dirty. Homeless people need to be helped. But if you just allow homeless people to be all over the street, well, ordinary people do not want to go. So the retail shops are closing down. Or in the case of shoplifting, well, massive shoplifting, of course, they don't make money and they have to shut down. So this is the retail absorption trend. The earlier part of the graph, when it was negative, that was just because of COVID. People are locked down. Most people are doing online shopping. But right now, with job creation, more people with paycheck, yet the net leasing is only mildly positive, or in some quarters becoming negative. I was surprised to see this in Salt Lake City. So Salt Lake City out there will be solidly positive, but again, you see the past 4 quarters, slight positive or slight negative. So no real increase in net absorption. But maybe people are doing through warehouse and industrial spaces, online shopping. So you need to put it in the warehouses. So it's mostly positive. So at least it's mostly positive, but it is not super positive. So in the first year of the COVID lockdown, it was very, very high, but now it is still mostly positive, but not that super positive. And in the Salt Lake City, again, similar situation, very strong in the first couple of years of COVID. Right now it's positive, but not super positive on the warehouse demand. So people are shopping. If they're not doing the retail shops, then they are just essentially doing online to be delivered to their home. Hotel industry is coming back strongly. Something to think about. Maybe some of you advise on Airbnb or have a rental property that you want to rent out to the degree that the hotel occupancy rates are rising, which probably is implying that there is a demand for Airbnb spaces as well. And this could be a part of the trend of remote workers essentially saying that if I can work anywhere, maybe I want to do also combine that with some travel. So occupancy rate beginning to rise. And now let me turn to the long-term real estate demand. So if there is jobs, and Denver, Salt Lake City, one of the fast job creators, Wyoming, positive job numbers. So if you have jobs, that's going to lead to more demand for retail spaces, more demand for hotel occupancy, more demand for apartment spaces. So there's more demand, except office. Somehow office is pretty much a ugly sector at the moment. People can have jobs, but they're not returning to the office leasing activity. So let's look at the job. So this is the total number of jobs in the US. How many people are receiving paychecks? So pre-COVID is the first 3 dots, pre-COVID. Then we had a lockdown, 20 million job losses. Since the reopening of the economy, more jobs, such that now we have 5 million more Americans working compared to pre-COVID. Well, where are these jobs actually occurring? And if you look at the map across the US, let me, for the sake of brevity, go to the map of the US. The jobs that are occurring in Rocky Mountain states, Utah, 10.1% more people working in Utah compared to pre-COVID, one of the top performers. Texas is adding jobs. Florida is adding jobs. Dark blue means fast job creation. As you can see in the CCIM Region 3, the Colorado 3.8%, respectable, about the national average. Wyoming trailing behind a little bit. But one thing on Wyoming is that the surrounding states, Montana is doing well, Idaho is doing well, South Dakota is doing well. This could be the part of the trend where people from big cities are seeking out more open spaces. But of course, Wyoming is also energy producers, and they have been more limited in energy production, at least through last year. This year is presidential election year, so they said, go ahead, produce as much oil as possible. So this year is different, but in the previous year, there was a lot of restriction about energy production, and therefore it may have hindered some of the employment growth in Wyoming. But as you can see on the chart, one wonders, okay, America is adding jobs, but where? Well, it's in this dark blue color state. That's where the job growth is principally happening. Let's look at the three states specifically. Colorado, from year 2000 to now. So from year 2000 all the way to pre-COVID, that little disruption towards the end, that's the lockdown. So you can see it's sort of steady job growth. Maybe during a recession, there's some job losses, then job growth, a new record high. Today, record high employment, 700,000 more people working in Colorado compared to year 2000. That is a demand for everything, real estate demand, demand for retail, demand for buying clothes, which means you need a retail shop. So this is adding that long-term commercial real estate demand. Let's look at Utah. Utah, similar, 700,000 job creation, same as in Colorado. Colorado has been one of the top performer, but Utah is outperforming Colorado. Let me go back to Colorado. Look at the beginning of this graph. Beginning is showing about a little over 2 million jobs, 2 million. But Utah was starting from 1 million jobs. So to add 700,000 on a lower base is much faster percentage growth in Utah. Wyoming, 60,000 jobs. Naturally, the number is smaller because it's much smaller employment base to begin with. But as you can see on the chart, from year 2000 to even up to 2008, there was job creation. Then no job creation from 2008 onwards. Then COVID hit, now trying to recover. So it's essentially a little bit above pre-COVID, but I think it's partly energy dependent. But maybe Wyoming could find, like Montana and Idaho, they see more people from big cities who want to escape to the open fresh air. So you may get more. And I believe some of the rare earth material has been found in Wyoming. So the mining activity in the future could lead to more employment base in Wyoming in the future years. So GDP number, CCIM member also wants to follow the overall GDP number. The way I interpret is if the GDP is positive, at least it's suggesting more future jobs. So in 2023, respectable 2.2% GDP growth or something like that. So one can anticipate more future jobs. But as I showed you on the US map, we know which state is actually adding more job compared to others. And the Rocky Mountain region is doing much better compared to many other parts. Forecast. I think the long-term interest rate will decline because for three key reasons. One, something that I belabor at the earlier portion of the graph or section of this presentation is that rents will come down from active apartment construction. That will make the Federal Reserve cut interest rate in the second half of the year. 3, 4, 5. Well, if we combine this year and next year, it's going to be 6, 7, 8 interest rate cut. So clearly interest rate will come down. Only hindering factor is the budget deficit. Second part, community banks are suffering, and only way to help community bank, something the Federal Reserve do not want to talk about, but I'm sure they are aware of it. So if they are aware of this situation, to help community bank come back alive is to cut interest rate. Cutting interest rate also helps commercial real estate, which means it helps community bank indirectly. So cutting interest rate will be very, very beneficial. So 3, 4, 5 rate cuts this year. I think there is that extra incentive to cut interest rate from the Fed to help out the community banks. And that will be a good news as community bank provides lending for commercial real estate. And the last point is something more technical. The credit spread between the benchmark risk-free asset and other asset has risen. So we have a wider than normal credit spread currently. So once this settles down, it's going to automatically make interest rate a little lower. As an example, right now, 30-year fixed rate mortgage on residential side is around 7%. If we had a normal credit spread, the interest rate would be more closer to 6%, 100 basis point lower. So getting the credit spread to back to normal will help. How do we get back to normal? Well, first, abnormal condition means it's not often. So maybe given that historically it's not often, it will return to normal. But the second point is, I think the community bank in their dire need for cash are selling some of their mortgage-backed securities onto the market, commercial real estate, mortgage-backed security, residential, and this is widening the credit spread. So if the community banks are healthier, that will reduce the credit spread. So again, many, many good things happen if the Federal Reserve cuts interest rates sooner and more deeply. So that will help commercial real estate, community bank, and positive feedback loop from that. So let's cross our fingers for more deeper cuts than what the Fed is officially announcing. Let me finally wrap up with quickly going into the home sales in the context of commercial real estate, land acquisition, and development. So home sales were actually very low last year on the annual existing home sales, but this was due to low inventory. If we look at the home builders activity, it was their third best year. In fact, home builders stock prices, Lennar, KB Homes, if you purchased their stock prices a couple of years ago, you would have gotten a huge return. So home builders are doing well, even though the realtors were challenged because of low inventory. And this is the inventory situation. Red is the inventory of existing homes, very low. While the blue, smaller market share, but you see rising because inventory is available, people are buying more homes. And we need to be mindful that the builder activity, even though they are building more today, they have underproduced from 2008, that red box, great underproduction. America is facing housing shortage. I'm glad temporarily we have overproduction of multifamily, but we also need many single family homes to be produced way into the future. It's not going to be solved for 1 or 2 years. We need more construction. And home price appreciation being this high. So Utah, 53% price increase, Colorado, Wyoming, 41% price increase in short 3-year time, implying housing shortage. We need to purchase land, get those lands to be developed. And this is where commercial practitioners can come in to sort of help bring more supply onto the market. Now, modular homes could also solve some of the housing shortage, but the mobile home prices have also risen. So blue is single size mobile home, the red is the double size. As you can see, this is another reflection of housing shortage. Maybe some of you out there, maybe you have a land and you lease out to the mobile home. So to the degree that you are doing, you can extract additional rents, but this is clearly implying housing shortage. So a way to address housing shortage is commercial real estate development for residential, whether it is apartments, whether it is single family, we need more of it because we have a housing shortage condition. And I'm forecasting that home sales will be rising this year. So with this anticipated growth, it will be terrific for organization to buy land, develop those land, and then sell it to home builders. So wrapping, my last slide is the following, my final slide. Fed to cut interest rates. 10-year Treasury today at 4.2, I think it can go down to 3.5% in the second half of the year. Commercial property prices, which have been falling, will begin to stabilize and in some cases may recover some of those losses as interest rate decline. Moderate GDP growth will still add to more leasing. So if you are involved in leasing activity, expect more business. Even investment sales can begin to come around once the interest rate decline. So even the transaction volume on commercial real estate will rise. And any exposure to land and single family home development, I think that is also very positive. business opportunity going forward. So let me stop there. So thank you very much for allowing me to share some of my thoughts with you all. And again, I want to thank CCIM, thank Dennis for inviting me to share the information.
Okay, thank you, Lawrence. We do have time for a few questions, so let's get started with those. One I wanted to ask you, Lawrence, is the news media and the government and different people put out inflation figures or where the economy's at, but they use all different kinds of indexes that they use. Can you tell us which index you prefer to use that you think is the like your preferred index?
Well, the headline information is that consumer price inflation. So if the consumer price inflation is showing 2 and other index measurement may show still uncomfortable levels, I think there will be a huge pressure on the Federal Reserve to say, look, Americans are seeing low inflation. Why are you not cutting interest rate? Now, Federal Reserve has indicated officially some years ago when Alan Greenspan was the chairman of the Federal Reserve that his preferred inflation measure is something called PCE in the GDP number. So that's personal consumption expenditure price index. And that number, again, is slightly above 2. I think those are unnecessary to go into all the detail. But if the overall CPI number is at 2, I think automatically the PCE deflator number that Alan Greenspan said he looks at would also be at the 2%. So I know there are different measurements out there. One sort of thing on the broader economic data is unemployment. So unemployment numbers are very tight, but I think that's unfortunate because the reason why unemployment rate is so low is we have so many Americans not even looking for a job. If we had more Americans looking for a job, all this help wanted sign will come down. We have more people working, that will be good. But we have very low unemployment rate because for one reason or another, there's a sizable number of Americans not looking for a job. And that is leading to this tightness in the labor market, which is also the reasons that you want to hire some property manager for property. It's hard to come by.
Okay, great. Another question that we have here is they're hearing that the U3 report is changing the way the stats have historically been reported, causing the aggregate employment rates to be measured different. Have you heard anything about that?
There is a different unemployment rate like U3, U6, whether one includes people who are half-timers, how do you include students? So there are different measurement on that. But let's look at the reality. The reality is that you walk down Denver, you walk down Salt Lake City, or say Fort Collins, Colorado Springs, and you see help wanted sign at a restaurant. This is implying that we are short on labor shortage. So because of this, some people say, think tanks in Washington who say, you know what? Why don't we bring more immigrants, whether they are documented, undocumented, that doesn't matter because we need more labor force. But I think what is missing in that argument is we have Americans who could do those jobs, but they are not going into the labor force. This bump up in people who are out of the labor force, that's really complicating. So if we can somehow incentivize more Americans to get into the labor force, I think that will help relieve some of the employment pressure, along with the fact that at least the argument about, let's bring in the undocumented worker, well, that argument disappears because now there would not be so much help wanted sign.
Okay. So the next question we have here, Lawrence, requires you to reach into your desk drawer and bring out that crystal ball that you probably have there. The question is, what do you think is the greatest single risk to the economy after the election?
So after the election, first, I think generally there is a slight aggregate improvement in the mood of the country after the election. I know that we are in such a politically divisive country, just mentioning President Biden or President Trump, he picks a certain energy level or discuss the testament of it. But the reality is that anytime presidential election year finishes, there's a little bit of improvement in consumer confidence. And I think that's from the fact that there was more people who voted on the winning side. So people are saying, "Oh, I voted on the winning side," and the fact that the majority won. So there is actually a little better. But I think, independent of the presidential election, just overall economic trend is that I think there's this budget deficit. America is very fortunate to be America through long history, 100 years of history, to say we are a country that respect property rights. We respect, and because of that, people are willing to lend money to America. And that's why we can have high budget deficit and not have very, very high interest rate. But once we reach certain tipping point and we lose that credibility, then the borrowing costs could really become very difficult, and that will be a huge negative hit to the country. So I would say look at the budget deficit number. Clearly, current situation is not a sustainable trend. I hope they don't do something called continuing resolution. So when you talk to the politician or in the newspaper, you read the word continuing resolution, fancy word, what the heck is it? It just means kicking the can down the road. So high budget deficit will continue. That's what it means. They've been constantly doing continuing resolution. So again, this Thursday, let's see what President Biden say, and let's see what Republican rebuttal to that speech is.
Okay, so I don't see any other questions in there. So Lawrence, thank you again for sharing your expertise with us today. As always, great information. I've never failed to go to one of your presentations where I haven't learned something and been able to utilize that. Also, just want to say thank you to everyone who attended this webinar with us today. As a reminder, the recordings and the accompanying presentation will be emailed to all of you registered attendees. And if you're not already a member of the CCI Institute or a course participant, take a moment to sign up for our e-newsletter at ccim.com to stay informed about the complimentary webinars like this one, as well as other professional development opportunities. Again, thank you, Lawrence, again, for taking your time to help us with what's going on in Region 3. And thank everyone out there for your time today, and hope you have a great rest of your day. Thanks, everyone.